Step 5. Project non-recurring items, provisions for income tax, and net income. I introduced the project dividends, retained earnings, and other comprehensive income items in step 4 already. So this step we only project non-recurring items and income tax. And all other items in the income statement we've already forecast. So after we forecast the income tax, the income statement is complete. So net income, forecasted net income will be available. For the non-recurring items, when we project financial statement or forecast the financial statements, we only keep the sustainabilities of earnings. Okay, so for non-recurring items, we simply assume their amount will be zero in future, because the definition of non-recurring item means they are not going to happen in the future. For income tax, income tax is a very important or significant part of expense for large companies. In our example, we should forecast income tax expense. What we should know is the income tax expense is a product of income before tax and the effective tax rate. So income before tax is available, as I highlight here. So we only need the effective tax rate. So actually, you got this from the Data tab. The effective tax rate or average tax rate for the past 5 or 6 years, right? So on average, from 2011 to 2016, the tax rate keep increasing. In 16, the tax rate is 25.6. In 15, tax rate is 26.4. So on average, the tax rate is 26. So I simply just use 26 as the forecast income tax rate in the future. Okay, so we just use the flat rate, negative 26%. When you click this cell, actually this formula represents the product of income before tax and the effective tax rate you enter in this row. After we project income tax expense, we have the net income. Or net income is updated. And here, because the net income changed, right? So it also affects the retained earnings we forecast in the step 4. So in the next step, we are going to we now complete the income statement forecast and balance sheet forecast. In step 6, we are going to balance the balance sheet. The reason is all the numbers we project for each account are based on our prediction, not based on real business activities. So we cannot guarantee the accounting equation is balanced. So here in this row, if you click this cell, so this is a comparison. E169 is actually total assets. The rest of these items are actually the right-hand side of account equation, liabilities and all equity accounts. So the numbers here indicates the accounting equation is now balanced, right? So we should balance the accounting equation by applying by making adjustments in a flexible account. So in step 6, I will introduce how to find the flexible account.